there's lots of speculation at the moment that we're going to move to a negative interest rate. So what you're asking me now is, what does this mean to my mortgage, my loans, my savings in the bank? So today I spoke to one of the UK's leading financial experts and my go-to expert on anything financial, Warren Shute. And I started off by asking Warren, have we ever had a negative interest rate before in this country?
No, we've never had negative interest rates in the UK. The Bank of England was founded in 1694, 327 years ago. And over those 327 years, we've never had negative interest rates. So it sounds really unlikely. However, it's not impossible. The European Central Bank, the Bank of Japan, the Bank of Denmark, Switzerland and Sweden all took their interest rates to below zero in 2014 to stimulate their economies after the global financial crisis. Good question. That's what everyone's really interested in today. There are two ways that you're charged interest rate on your mortgage. The first is a fixed rate. And if you're on a fixed rate, that means your rate isn't going to change because it's fixed for that period of time. The second is a variable rate. And if you're on a variable rate tracker mortgage, it means your interest rate tracks the underlying interest rate base rate. So it could come down. It's unlikely to go below zero, particularly if your mortgage was taken out in the last few years. More recent mortgages have had collars put on them or a underlying 0% rate. That means you can't go into negative rate territory. However, older mortgages might still be available to go into negative rate interest rate territory. The lowest rate we've seen is 0.75 with in Denmark, where effectively borrowers were paid to take out a mortgage. However, after the fees and costs, they weren't actually making any money by taking a mortgage out. Good question. I guess what's important to remember is there's a difference between the central bank, so the Bank of England base rate, and your retail bank's base rate. They are different. And although in theory we should be charged to have money on deposit, the reality is we'll probably see our already minuscule interest rates come down from wherever they are at the moment down to 0%. So there's no net gain for you to have money on deposit. Effectively, you're running at a loss after inflation. If they went to negative and started charging you to hold money on deposit, I think we would see smaller savers pull their money out and just keep it in cash, put it under the bed on deposit in themselves, as it were. And I think you'd see larger investors pull their money out and invest it in short-term AAA rated bonds. So loans are generally fixed rate interest rates. They're not variable rate interest rates. So what the rate you're paying is what you'll pay throughout the mortgage, the loan period. If you took your loan out some years ago, you might be paying a higher rate than you can get today. So it might be in your interest to look around at the market, see if you're able to save yourself some money.
So there you have it. All the answers from Warren, one of the leading financial experts in this country. If you have any other financial issues, do go to Warren's website. It's displayed on the screen now, www.warrenshute.com. As this story develops, if indeed it does develop, we'll bring you more information about what a negative interest rate is going to mean at the time.